Larkworthy from FIIG, live to the minutes. Tim, welcome to you. That's the kind of, again, the global story beginning to build, and maybe in the UK's case getting there a little faster than we have on inflation, but certainly we found unanimity on the wages piece, which is not meeting or matching those gains for CPI.
Yeah, certainly, Carson. Good to be with you. Look, the Bank of England certainly surprised the market last night. As you said, the Monetary Policy Committee had a vote. It was 5-3 in retaining rates at the current levels, which was no great surprise. The surprise was very much that 3 members decided to vote for an increase in rate, which would have been the first time they had done this since 2007. Now, the main driver of that seems to be coming more from inflation than anywhere else. Certainly, the numbers that were released earlier in the week indicated that May's numbers were showing 2.9% compared to April, which was 2.7%, and the driver of this again seems to be coming through the weaker pound. Certainly, areas such as computers, laptops are pushing the cost of those goods higher from the fall in the currency. Certainly, there are other factors as well. Food is becoming more expensive on the import front, as well as gas and electricity prices are going up as well. So, as you point out, certainly the economy is soft overall. They released some data on retail sales, which is the softest growth in 4 years. So it's a mixed message, very much so.
And this is at a time when, from a fiscal response, never mind the monetary piece, you've got a pushback on austerity, a big reason given for the slide and support for the Conservatives and the rise of Jeremy Corbyn's Labour recast movement. Now, is there a sense here that the corporate balance, that the sovereign balance sheet can be tapped at a moment like this to really build out the promises made, rather than just having them remain as platitudes?
Well, it's a dichotomy that's facing a number of countries at the moment, the US and Australia as well, that there is this sort of pushback on austerity. You know, I think that the main monetary policy committees around the world will focus on their main requirements, and that's to promote employment and to keep inflation under control. And that should be their focus, and I think they'll adjust interest rates to accommodate that.
Yeah, well, therefore, bring it all home, because we got that release this week for domestic jobs. Enthusiasm for RBA cuts is now right down to 10%. What say you to hikes even in 2018? What's the House view?
Well, at this stage, certainly the data was stronger than expected. As we know, jobs data inherently is very volatile on a month-to-month basis, but certainly over the last 3 months, those figures seem to be confirming that it has been a solid improvement in the jobs data. So at this stage, our view is that a rate cut is most likely off the table, but that doesn't necessarily mean that there's going to be a rate rise anytime soon. So I think 2017 we can put away. 2018 will be dependent on whether the data continues to paint the picture that it's currently doing at the moment.
So appetite for corporate issuance in that kind of holding pattern environment, how would you characterize it? I'm just looking even out at the 10-year UST rising 3 points, but sitting still around 2.16, so it's pretty accommodative.
No, it is, and Australian rates, 10-year bonds, are still around that 2.4, 2.41 level, so the spread between the Aussie 10 years and the US 10 years is still holding around that 25 points. Not quite as low as it got to earlier in the week, but I think we've got to keep in mind that these levels, even in the 20s, are at historical lows. We just haven't seen these levels for any length of time for many, many years, and at this stage, the risk is that they could go lower.
Wow. Tim, check in with you next week. Thanks so much.
Pleasure. Thank you.
Tim Larkworthy from FIIG there live.